Warren Buffett, otherwise known as the Oracle of Omaha, is known as one of, if not the best investor of all time. With a net worth of $107 billion, it's not hard to see why. Alongside his partner, Charlie Munger, he brought up Berkshire Hathaway to an astounding net worth of almost $1 trillion. From living in Nebraska to running Wall Street, Warren Buffett has had a long career in finance. The new kid on the block, however, compared to Buffett, Cathie has also made a name for herself on the world stage. She's the founder and CEO of ARK ETFs, and in 2020, all 6 of her portfolios had returns greater than 100%. For comparison, the S&P 500 only grew a mere 16% that year. At its peak, her hedge fund amassed $15 billion under management. Now, let's find out how these giants of investing differ when it comes to their strategies of dominating Wall Street. Warren Buffett follows Benjamin Graham's school of investing, value investing. This strategy looks for securities or stocks that are priced unjustifiably low compared to their quote-unquote intrinsic worth. This means that instead of looking at supply and demand in the stock market, Buffett looks at the company as a whole. He doesn't care if the stock market looks unfavorably at his stocks, because he doesn't subscribe to the efficient market hypothesis, which is the idea that stocks always trade at their fair value. He and most of, if not all, other stock traders believe the stock market undervalues certain stocks, but that eventually the stock market will recognize their intrinsic value and increase the stock's evaluation. Buffett loves to paraphrase a certain Benjamin Graham quote to illustrate this idea. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. Now, we have talked a lot about intrinsic value, but how do you find that value, and when does it come into play for Buffett? There are 6 main steps to Warren Buffett's investment approach: evaluating company performance, company debt, profit margins, whether or not the company is public, the company's reliance on a commodity, and finally, whether or not it's cheap. Evaluating a company's performance means looking at the company's ROE, or return on equity, which is found by dividing net income by shareholders' equity. To analyze the historical performance of the business, Buffett looks back at least 10 years to get a better understanding of the company. Warren Buffett prefers to see a small amount of debt because it means the growth in company earnings stems from shareholders' equity as opposed to borrowed money. Company debt is found by dividing total liabilities by shareholders' equity. The higher the debt, the higher the ratio. Profit margins are calculated by net income divided by net sales. Although the margins are important, the marginal rate uncovers the rate at which the company's profit have been increasing, which shows just how fast or slow the company is growing. Buffett cares about whether or not a company is public, because public companies must disclose data including current and past performance. Commodity reliance might be a weird thing to say. You might be thinking, tons of companies have great businesses while relying solely on one commodity, like, for example, oil. But Buffett won't invest in a company that sells the same thing as all its competitors. The company must have a unicorn of a product that differentiates itself from the pack and is hard to replicate, so that others can't profit from their idea. Last, but certainly not least, is seeing if the company is cheap. For a company to check all of the previous 5 boxes and be cheap is quite difficult. Warren Buffett first analyzes a number of business fundamentals, including earnings, revenues, and assets, to figure out the intrinsic value of the company. Then he compares the intrinsic value to what the market values it at. If the intrinsic value is greater than the market value, then boom, you have just found yourself a great value stock. Warren Buffett has invested in some amazing companies such as Apple, Bank of America, American Express, Chevron, Coca-Cola, and Kraft Heinz. Now, let's talk about Cathie Wood. Her investment strategy centers around identifying high-impact innovations. Currently, Wood believes that artificial intelligence, DNA sequencing, robotics, energy storage, and blockchain technology are areas of innovation that will have immense growth and change the global economy as we know it. Cathie Wood, full name Catherine D. Wood, has two key concepts that create the foundation of her investing strategy. Not all innovations produce the same opportunity, and both top-down and bottom-up research is needed to identify the best investing opportunities. What does she mean by not all innovation produces the same opportunity? Well, innovation that creates opportunity has to cut costs in order to encourage quick adoption. And these innovations/solutions should create large-scale efficiencies and generate momentum and demand. Wood believes these investable innovations span sectors and geographies. Most importantly, it should foster more innovation. Fostering innovation leads to a longer-lasting growth cycle and a larger market. A top-down and bottom-up research plan involves first looking at the affected market size and the big picture trends of the innovation platform. Second, Cathie Wood researches the finer data to identify companies that are leading or advancing the disruption in the market. Wood assesses potential investments by looking at their culture, execution, barriers to entry, product leadership, valuation outlook, and risk. ARC also looks at crowdsourcing, social media, and company reports to evaluate sentiment about the business. Wood believes that these companies have less than 5 years to perform to their fullest extent. She thinks that in less than 5 years, the company may be too volatile, but further than 5 years, the company's growth may slow. Cathie Wood looks for a minimum of 15% on annual returns for any of her stocks. Some major companies ARC has invested in include Tesla, Trimble, Block, Coinbase, Exact Sciences, and you guessed it, our favorite COVID stock, Zoom. Unlike Warren Buffett, Wood stays away from value stocks and many Fortune 500 companies. But both of these investors are legendary, and I hope that you see the similarities in their strategies, even though they may seem very different. Please like and subscribe for more content like this.